The cloud-based service provider DigitalOcean, its stock price is down 73% off its high. And in this video, I'm going to make my case for why this makes an excellent investment heading into 2025. I'm going to share with you the company's revenue growth, its cash flow from operations improvement, its operating margin improvement, its improvement on return on invested capital, and finally compare that all against its relatively inexpensive valuation to make my case for why I think this stock is a buy heading into 2025. So let me share with you the details.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So as I highlighted in the introduction of the video, DigitalOcean's share price is down 73% off its highs that were reached in 2021. Of course, the bulk of that decrease in share price happened in 2021 and 2022. Since then, the share price has recovered slightly, but nowhere near reaching the highs of 2021. So I think the company is still an undervalued growth stock to buy. Let me share with you all the reasons why I think that's the case. Starting with revenue improvement, the company's trailing 12-month revenue improved to $756 million in the most recent period. That's up from a little over $300 million in 2021. So it's more than doubled its revenue in the past 3 or 4 years. That's solid improvement for a company, and it has similar runway ahead for its products and services. Most notably, there was a bit of a slowdown in growth in 2022 and early 2023. Remember, this is when businesses were fearful of an oncoming recession, and that was a result of the increasing interest rates from the Federal Reserve that made enterprises more cautious on spending. And so one business that experienced a slowdown was DigitalOcean, as other businesses looked to cut spending in any area they could find to prepare for a potential recession. So as we went through 2024, it appears those risks of a recession were overblown, and companies are feeling more comfortable about economic prospects going forward. And that's especially more evident now that the results of the election have made business conditions more favorable. And so DigitalOcean weathered that storm and has come out stronger than before. And one of the great numbers from DigitalOcean is its cash flow from operations to sales number. At 38.6%, it's a really strong number, and it's continued to improve over the years. This is demonstrating the company's asset-light business model connected with the cost controls and the leverage in the business, with each incremental dollar of sales leading to significant increases in cash flow from operations. This number is more than doubled from the 18% in 2021. This is great improvement, and this isn't something you see from companies that are trading at the valuation I'm going to share with you towards the end of the video. A company with this kind of improvement in revenue and cash flow from operations typically sells at a much higher multiple than what DigitalOcean is selling for. And you can see similar trends in its operating profit margin. Although the number is lower at 9.2%, it's improved meaningfully from the negative 7% in 2022. The most notable reason why DigitalOcean's operating margin is lower than the cash flow from operations is because the company uses stock-based compensation, which is a non-cash expense. It's still an expense because you have to account for that on the income statement, that you're paying employees in stock grants or stock options, and you have to account for that. So that reduces your profits, but it doesn't reduce your cash flow, because that's a non-cash expense when you give the employees stock-based compensation. So that explains the big difference for DigitalOcean's operating margin and cash flow. And you see similar excellent improvement on DigitalOcean's return on invested capital. This metric is important because it demonstrates a company's ability to take investor capital and invest it in opportunities that generate profits and cash flow for shareholders. This means the company is good at using money to offer services that generate profits. That's essentially the core skill that you want to see from a company that you're investing in. You want to see them being able to take your money that you've given them, right? Investors give companies money, and the companies use that money to create products and services and maintain products and services. You want to see them do that effectively, regardless of the area, the industry, the product, the service, whatever it might be. You want to see them serve that industry, serve that customer segment effectively. And that's what DigitalOcean has proven. And not only that, but that it's improving, it's getting better at doing what it does, which I love to see progress. 7% is not that large of a number, but the improvement is solid from -5 to 7, and the slope of improvement is increasing. The rate of improvement is increasing, as you could see here. All right, so all that being said, this wouldn't make a good investment if the price was too expensive, right? You can see the best car on the lot. It has all the bells and whistles, but when you go and look at the price tag, you might say, oh, okay, never mind. It's a great car. Everything is great, but the price is too expensive. I don't want to pay that price. With DigitalOcean, you're getting all those great characteristics, and you're getting a relatively cheap price. When you're measuring by the forward price to earnings, it's trading at a forward PE of 19.2, which is near the cheapest this stock has traded for, going all the way back to January of 2022. So the price has remained muted. All the while, the business has improved. The cash flow from operations has improved. They've achieved larger scale with growing revenue. They've achieved better operating profit margin, better return on invested capital. All throughout these last 3 years, those fundamental metrics have been improving significantly, and at some of those metrics at an accelerating rate. And the valuation has remained relatively the same on a forward PE basis going all the way back to January of 2023. And if you go back further, the valuation has also actually gotten cheaper. So it hasn't stayed the same, it's actually gotten cheaper. So you're getting all of those great characteristics at a bargain price. So for all of those reasons, and I've had DigitalOcean stock rated as a buy all year long in 2024. And I'm updating that recommendation today, December 19th, highlighting that I think this is one undervalued growth stock, an excellent undervalued growth stock that investors can buy before 2025. Now, of course, you should do more due diligence than just watching this video and making a decision just based on this video. You should take this as an introduction that DigitalOcean is a stock that's worth researching further and considering for portfolio additions. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.